disappointing job data, chaotic presidential transition, worsening virus spread, and volatile stock market. You have been bombarded with 24/7 news and endless questions about the stock market. How do you make sense of all these things?
In this video, I will help you narrow in on the 4 most important news. I will also reveal 2 Wall Street secrets of analyzing where stocks are headed. At the end of this video, you'll find out my top tip for the current stock market. Let's get started. Last month, President Trump signed a $900 billion relief bill as the second round of stimulus. It included a $600 stimulus check per person for most Americans, $300 supplemental unemployment benefit extended through mid-March, extending eviction protection through the end of January, and another $284 billion to the Paycheck Protection Program. This should get most struggling families through the next few months. In addition, as the Georgia Senate runoffs ended, we now have a united government in the next administration. The passage of additional fiscal support will be more likely and quickly. The third round of stimulus could include $2,000 per person stimulus checks, expanded unemployment benefits, and relief for the state and local governments. Now on the vaccine front, with over 20 million doses of vaccine distributed and 7 million people who took the initial vaccination, we have officially started on the path to herd immunity. It is estimated that we will reach herd immunity in the summer with 70% of the population through either actual virus infection or vaccination. This is pretty exciting. As more people reach immunity, the economy should recover quickly. Now turning to the Fed, the dual mandate of the Federal Reserve is the ultimate goals of price stability and maximum employment. We are far from these goals. Unemployment remains elevated and current inflation is still below the 2% target. And with the new inflation averaging policy, the Fed can be flexible even when inflation overshoots, where in the past they have been forced to raise interest rates. That means monetary policies will stay easy for a while. All those are quite positive news, but what do they mean for stocks? I will now expose 2 of the biggest Wall Street secrets. Before I talk about where stocks are headed, you need to know Wall Street secret number 1. Investors know where the stock market returns come from. What does that mean? Let's rewind and understand why 2020 was a strong equity market, despite it being the quickest economic contraction. You see, the price of a stock is determined by how much earnings a company generates in the future and how much investors are willing to pay for those earnings. When the economic crisis hit last year, the earnings of a company declined. But when the Fed lowered interest rates, investors discount future earnings at a lower interest rate. That is like dividing a smaller numerator with an even smaller denominator, and you get a bigger number. You just gotta trust me on the math. That means the present value of future earnings ends up being higher. In other words, investors are willing to pay a higher price for earnings because the stock's future earnings now look a lot more attractive relative to bonds and cash. In this chart, I decompose 2020 stock market returns into 5 components. Companies in the S&P 500 index paid 2% dividends and bought back 1% of shares, the blue columns. But these companies also lost a lot of earnings because sales fell and profit margins contracted, the orange columns. That will normally translate to a bad year for stocks. But because lower interest rates and other factors, investors are willing to pay a much higher price now because the smaller denominator we just talked about. That means a higher price to earnings ratio or PE ratio, the green columns. So those components netted out to be a strong 18% return for 2020. Now let's look at 2021. I will start with the easiest part. Dividends and share buybacks are pretty consistent across years. They should come in at 3 to 4% next year. Next, between current and possibly additional support from the government, consumers and businesses should survive through the tough period of the next few months. With vaccination rate increasing and the US population reaching herd immunity by summer, consumer demand should bounce back nicely and business earnings should also improve. I'm forecasting sales recovering 8% and margins rebounding 22%. The current expectation based on Wall Street analysts' forecast is for earnings to grow 37% in 2021, the blue columns versus the green columns. But that doesn't mean the stock market will return 37% next year, because the most important part of forecasting stock market return is what price tag investors are willing to pay for those earnings. Last year, investors paid 40% more in price to earnings. Are investors willing to pay more or less this year? Most people don't know how to price the market, but in just a few minutes, you'll be able to do that after I reveal Wall Street secret number 2. Investors determine price to earnings ratio based on interest rates, equity risk premiums, and long-term earnings growth. Now we're talking about interest rate. It's gonna get pretty interesting. Previously, I talked about how the current and additional stimulus along with vaccine and the dovish Fed will create a faster recovery, therefore pulling forward the Fed's liftoff of interest rates. This is evidenced by the recent bond market trading yields higher and the yield curve steeper. We have seen the 10-year Treasury yield, the bellwether of the long-term bond market, steadily climbing from 0.5% in the summer to 0.9% just last week, and breaking out above 1.1% in the last few days. If we get through the next couple of months and vaccination stays on track and the Fed remains dovish as it has promised, then long-term bond yields should continue to trend up as the economic recovery picks up speed. At higher interest rates, I, as an investor myself, will pay less for stocks because now bonds are marginally more attractive. This is bad for PE. Equity risk premium is a simple concept. How much more premium do I require to take the risk of owning a stock relative to the risk-free cash and government bonds? Early 2020 saw a rise in risk premium for stocks as things got pretty bad for the businesses behind each stock. Since then, risk premium came down as we reopened the economy and businesses were on the mend. So, when I put on my investor glasses, I see businesses less risky and therefore require less risk premium for stocks. But since risk premium already fell to pretty fair levels, I am reluctant in willing to pay a higher price. This is modestly bad for PE. Prices follow earnings over the long term. I am willing to pay more for an asset that grows its earnings quickly. You can see here that investors pay higher PE during periods when long-term earnings growth expectations were high. This is a unique crisis in which investors are willing to look beyond the bad earnings in the near term, an expectation that earnings will recover quickly and that long-term earnings growth will resume. This is good for stocks now, but this disconnect between higher PE and low long-term earnings growth could be problematic going forward. Given moderately higher interest rates, fair risk premium, and recovering long-term earnings growth that's already priced in, I think investors are willing to pay a lower price to earnings ratio as earnings recover. That could mean 10 to 20% PE contraction if we go back to the 19 times forward PE ratio before the crisis began. This is going to be a cocktail party for stocks. The combination of recently passed fiscal package, including the stimulus check, the increased probability of additional fiscal stimulus under the Biden administration, the vaccination of the population, and the promise of a dovish Fed make a very powerful cocktail that is extremely supportive for stocks. See the orange column. At the same time, investors may not want to pay as high of a price to earnings ratio going into 2021 because of the balance of rising interest rates, fair risk premiums, and recovering long-term earnings growth that's already priced in. See the green column. Absent unexpected events, this should be a good year for stocks. See the gray column. But I could be wrong. If vaccination rates slow down, or additional stimulus doesn't come through, or the Fed hikes unexpectedly, or interest rates rise faster than expected, or any exogenous event causes earnings to fall and risk premiums to rise, then stocks will experience volatility and possibly a lower return. However, I am generally optimistic that things will work out in the long run. So how should you play in the current market? The powerful combination of fiscal and monetary policies will likely reflate all assets. This connected with the current weak economy and worsening spread of the virus. In other words, a rising tide lifts all boats. We've seen this happening since the market bottomed in March of 2020. Because the return on cash and bonds are so low, money chased after higher yields into stocks and real estate as investors started to feel more comfortable. That rising tide lifted the price of virtually every asset, from Amazon stocks to US real estate to even Bitcoin. Even though I believe the tide will rise at a slower rate than last year, the tide will still rise. That means you don't want to be on the sideline with your boat docked on the shore.
Get in the water and participate in the market.
One of the best things you can do as an investor is to stay invested, with stocks and other assets producing positive returns in most years. By staying out of the market, you're essentially giving up risk premium you can collect. If you want to learn more about investing, please check out my other videos where I talk about investing. With the expectations of slowly rising bond yields, bonds will likely fare poorly, defying the traditional role of protection and ending the unrepeatable 40-year descent of interest rates. So I wouldn't want to get into that boat. But which boat should you get into? Well, I'm gonna leave you with a teaser here, because I will be talking about exactly where you should invest your money in my future videos. Stay tuned. If you find any value in this video, please click the like button and feel free to share it with your friends and family. And subscribe to my channel for more information on how to make money, invest, and managing wealth. See you next time.